Welcome to another episode of Home Seeker Podcast. I'm your host, Andy, and today we're going to delve into the 5 compelling reasons for purchasing a property in 2024 in our beautiful country, New Zealand. The dream of home ownership is more than just an aspiration. It's a pathway towards financial security, stability, and long-term wealth. Today we'll explore the unique advantages that make buying a home a wise decision. Whether you're a first-home buyer or considering adding to your investment portfolio, this episode is for you. Today, we've been joined again by a familiar face, Simon from Mortgage HQ, one of our senior financial advisors here, someone who has bought property, somebody who has invested in property and has a wealth of knowledge. And today we want to run through those 5 compelling reasons why purchasing a property in 2024 is a fantastic reason. The first one that we're going to touch on is government incentives. Let's talk about these incredible incentives that we get from the government and some of the changes that we might have seen in the last 12 to 24 months, and also some of the first home buyer grants as well that are available to you. We know these schemes provide additional financial support and make achieving these aspirations a lot more attainable and achievable. So Simon, what's changed? What does the scope of home ownership look like through these grants, and what is required?
There's been some slight changes. Some of the changes are in relation to accessing the first home grant by the limitations that were previously introduced, which was the house price cap, right? And so that has actually increased, and you can find this across many different websites, but one of the ones that you can find on is the kaiongaora.govt.nz government website, and it shows you what price caps are there. But ultimately, in short, they've increased. So what that means is that, previously where you're looking to purchase a property in Auckland, and it seems like, well, the only thing I can pretty much purchase these days to get the $5,000, or depending on how long you've been in KiwiSaver grant, is something that's like entry level. It's like 1-bedroom apartment or
600K or something, yeah.
It's crazy. So there's no way a family that are looking to buy a home is going to be looking in that range. Now that it's increased, I think it's $875,000 for the Auckland market. And that's for new build and existing properties now. So really, ultimately, there's been a leveling out in terms of incentives from new build and existing. That's another problem for new builds if you're promoting new builds out there, guys. But no, I think ultimately the incentives have levelized in terms of the types of properties you should be going for, and you can access the grant for properties that are higher.
It makes getting onto the ladder easier. And the reason we want to get onto the ladder to purchase property ultimately is security, right? Owning your own home doesn't mean you have to deal with the rent rate increases. You don't have to answer to somebody else. You don't have people coming around checking if your home is clean and tidy. You've got the security of your own home. Yes, you pay a mortgage for this. However, when we're looking at the security, what does that security, Simon, allow people to do moving forward?
Well, I think it merges the security and government incentive, because the government, I would consider from the finance perspective, the Reserve Bank, right? The Reserve Bank has instituted some lowering of LVRs, right?
What is LVR?
Loan to value ratio.
So what does that mean?
So a lot of our clients we want to work with, we don't want to work with them just to get their first home. We want to actually help them build wealth, right? And so it's about buying a first home for a purpose, buying a first home and then buying another home and then buying another one. And that's to grow wealth, to be able to pay down your mortgage faster, because ultimately we've got both the government incentives through the RBNZ of the reduction of LVR, and then also the security. So you own your own home now, and now in an upward market, of which we are currently in 6 months to a year, it's quite feasible that people are in a position to buy their first rental property as well, first investment property. That's going to make a massive difference if they do that as early as possible. So yeah, security, the bank will control your property, but you could look to utilize that as security to buy the next home. And you don't even need to have the cash available to do that.
So what we're talking about is the ability to use leverage. Now, the concept of leverage is an extremely powerful tool in real estate. By investing a fraction of the property's value, we're exposed, I should say, to the full extent of the capital gains. In New Zealand, it's a very robust market, and it means, or can mean, significant returns on your initial investment. Not to mention the potential rental income that you could build through renting these properties out, and whilst also building equity. Simon, you've dealt with a lot of clients. Give me an example of where this has worked, and I think this one is actually going to be more close to home than others might realize.
Yeah, I think a lot of people don't take into account the returns on leverage. And so what I mean by that is that someone will say to me, hey, I got 10% return on my share portfolio last year on Sharesies. Good stuff. But how much could you leverage of that to then get the return on that total value? And what I mean by that is that, say you put $20,000 into Sharesies and you get a 10% return. If you put that $20,000 towards a deposit into a property that's leveraged, then you get a certain percent, let's call it 2%, 3%, 5% on the total value of the home. And say that home's worth 100, 200, 300,000 based on the 20% deposit. Now, obviously, I know we can't purchase a property for that amount. But what I'm trying to allude to here is that the returns on the initial investment is for the shares, and the return on the total value of a property, you have to take that into account, because if it's $1 million property going up by 5% a year and you got your 20,000 or 200,000 in a shares account getting you 10%, 15% a year, is still not going to compare, because the return on $1 million is, even if it's at a lower rate, is far greater than a return much higher on a small deposit amount.
Correct. So what you're more or less saying is that if you've got $20,000, you've got a 10%, let's use whole numbers. You've got $50,000, you've got a 10% deposit on a $50,000 property, $500K. That $500K is going up, let's just say by 5%. You've also got the same $50,000 that you're going to have a 5% return on. Now
Or a 10% return.
But let's just focus on 5%. You've got 5% on both. With the compounding interest effect, you'd rather have 5% return on 500,000 and you've still only put 50,000 in, opposed to 50 grand cash, giving you a true 5%, because there is no capital gains built in. So what we're saying is, by leveraging in property, you've got the ability for that 5, 7, 10% to go much, much further and create another opportunity. Because by doing that, when you have more than one asset, more than one value, what you're allowing it is that 5% is now spread over 1, 2, 3, or 4 properties, creating greater opportunity moving forward, which is why we're a massive advocate on leveraging your opportunity through property. The best thing about this, other than your owner occupied, other people are paying this mortgage for you, this debt. Yes, you've got the tax, and yes, you've got the rates, but even if you're putting 5 or 10 grand towards a property, you're still leveraging a greater return on the large portion of it. So it makes sense, right? And that goes to setting up for the future, right? So buying your first home is a step to securing your future. It's not about present comfort, but it's about leveraging equity growth to upgrade or invest down the line. This initial investment, right, can pave the way to more significant opportunities, making it much, much easier to achieve your long-term financial goals. And I know, for example, we'll bring this up, your brother, you've helped him in a very, very similar way, moving to the first, moving to the second. Now, negotiating on the first home was a unique tool, which you really helped him. But let's just get an overview on exactly how you did that. And it wasn't a massive purchase price on a property, right? There was not a lot of money that was put down, but talk me through that deal really quickly so we can help people understand that you don't need the 400-500K to make this happen. How did you help your brother make this first move into first home and then leveraging to get a second, or looking to get a second?
Like we talked about with taking advantage of the leveraging power of things, I wouldn't have treated my brother any differently than I treat my clients. So what I mean by that is that I give 100% to my clients, my brother, everyone. And the results that I've seen from my clients sometimes outstrip what I've helped with family. It's probably circumstance. But to be specific on this property purchase, he purchased a property here in Auckland. It was probably about a year ago now. And he purchased it for just under $500,000. And now it's worth closer to $600,000. And this was even down during a downturn, And we've just done another review, and he has capacity to buy his first investment property. And this is like the perfect model. Right? This is exactly what we want to see for our clients. And that's what we're talking about leverage. People will be saying, hey, look, I'm just trying to buy my first home. Why are you talking about this extra leverage thing? And why are you talking about setting yourself up for a future? I just want to buy a first home. Well, when you come to us and you talk to one of the financial advisors here, we actually have capacity to have forethought. What is going to be the plan for the next 10 years? Is this first home going to be the one you're going to be living in for the rest of your life? Yeah. And so how about we plan for a little bit more than that? How about we look for something that's going to provide a little bit more resilience to your financial future, something that's going to help your family out. And so that's my hope for all clients that I work with, is that we have plan to take advantage of some of these things that property provides. And so in short, brother of mine, we got to purchase at about the 450, 500K range, is closer to the 600, 650 range. And now he has capacity to buy a high yielding property in the regions of which we generally promote. He has capacity to do that, other than just sitting around doing nothing. So now he's got close to looking into the future, about a $900 to $1 million worth of portfolio, and will do him well when it comes to capital gains in the future.
Talking about a portfolio worth maybe $1 million, was his down payment 10% or 20% of that purchase price? Was it within 5, 10, 15, 20? What sort of area was it within? 10-ish, 15-ish?
And this comes back to the beauty of leverage again, is because he owns his own home in Auckland now with the 20% down payment required up front. Now he's got so much equity in that property, he actually needs to put no cash, $0. And now he gets to buy his first investment property. People talk about like, how do I get there? Well, it's a lot easier than you think, you know? And when you work with some of the advisors here, you have capacity to grow these things a lot faster by taking advantage of some of these leverage techniques. So in short, to answer your question, he put a 20% deposit down initially.
So we're talking 450, 500K purchase, so like 80,000, 90. And as a couple, based on KiwiSaver, if you're growing up, that's not unattainable. We're not talking $200,000 here. We're talking maybe an $80,000 to $100,000 deposit. He did it on his own, but joint is now allowing him to have $1 million portfolio potentially. Now, one thing I really want to, push forward here is that we're talking about buying an investment property within the regions, right? A regional property because the cash flow is better. We don't need to go and see the property. We don't need to go down there and do all of that. We need to make sure the numbers work and it's a safe investment. So we need to get out of the mindset, I think, of buying in Auckland, an investment property in Auckland where the yield is a lot lower. So what we're saying here is that setting up to buy your first home can definitely set up your future if you look for the right deals. Now, you can talk to a lot of people about how to find that, but what we've seen today is there are compelling, tangible benefits to buying property in New Zealand, particularly in 2024, as we're just starting to move into a more aggressive market. From the government incentives to the strategic use of leverage and the promise of long-term stability and growth. And I'm not saying this is going to be easy, because if it was easy, everybody would do it, okay? I might just tip the scale in favor of making one of the most significant and rewarding investments of your life. We're not saying it's the only investment, but it's going to be a massive part of that. Now, of course, we'll always want to provide you with an unbiased view of properties. Hence, the next episode, we're going to cover the 5 reasons you don't want to buy a property in New Zealand in 2024. In short, thank you very much for joining us. We look forward to guiding you through more insights and tips in the more episodes to come. And again, thank you for joining us, Simon.
Thank you for having me.